Hey, it's Dale Schaefer with Life Moves Wealth Management, and I wanted to bring to you a question that one of my clients brought to me a couple of days ago, and the starting question sounded a bit like this. Hey man, this market is crazy. What are you saying to your other clients right now? Okay, good question. Let me get a little more context into what you're asking. And so we started talking and I was probing a little bit more, and what the real question kind of came down to is very simply that he was feeling a lot of concerns about some of the things that are happening politically and from the Federal Reserve and in the stock market and in the economy and with inflation and all these things. And so the question is, hey, these people, politicians and the Fed, they're in charge of this stuff. Why are they intentionally trying to slow down the economy when we really haven't recovered still from the pandemic, and not everybody got to experience the same highs and the same lows? And why are they doing this to us? All right, now we have a question I can work with. So we started talking through some of the factors that are involved with what we're currently seeing now. So go back in your memory banks to December of 2019, maybe the tail end of November 2019. We started hearing about this strange flu that was coming out of Wuhan, China, and people were just falling over sick, falling over dead, all that kind of stuff. Nobody knew what it was. Over the next couple of weeks, that became a world health crisis, that then became an epidemic, that then became the pandemic as we know it. So March of 2020, we're all locked down. Congress passes a massive stimulus bill called the CARES Act. The Federal Reserve responds in kind by dropping rates all the way down to zero. Treasury prints a bunch of money, and then off it goes. Money just floods the market everywhere. Individuals were getting a lot of stimulus. Businesses were getting a lot of stimulus. Thousands and thousands and thousands and hundreds of thousands for some dollars completely into the market with nowhere to go because we're locked down. So traditionally, a stimulus is where you get a little bit of money from the government and you go to your local restaurant or you go to your local shop and you buy goods there, so that way the economy in your area gets propped up and supported, and people can keep their jobs and they can maintain wages and afford to pay rent and go to the grocery store and that kind of thing. Well, we were locked down and we were told that we couldn't go out, and a lot of places were closed. We permanently lost a significant number of small businesses through that period. Permanently gone, never going to open again. You could barely go to your grocery store without walking in a line and only following the arrows, and you couldn't get basic needs, toilet paper, rice, noodles, all that stuff was gone. Couldn't get eggs, couldn't get milk, all of that. So money started going into other places. It started going into the stock market. It started going into housing. It started going into home improvement. It started going on to e-commerce and Amazon and places like that. And a lot of those goods are made overseas. And the goods that are made overseas are made in countries that have different COVID experience than we do. And they had different lockdown measures than we did. In fact, China still has different COVID restrictions that we no longer have. So all of that was happening. We had too many dollars chasing not enough goods, and so we had a supply chain interruption. Remember when the big ship, the Ever Given, got stuck in the Suez Canal? And remember seeing the videos of just lines and lines of container ships for as long as you could see, just anchored off the coast of Long Beach, California, waiting to get into the port to unload. All of that stuff started happening, and so now we get inflation. So inflation is the price we pay for that level of stimulus. And because of all of that, now we have things that are happening at the same time in the economy that generally are a little disjointed, but they're all just kind of firing at the same time. We have a stronger dollar. We have an inverted yield curve, and that means that right now the 2-year Treasury is yielding just over 4%, and the 30-year Treasury bond is yielding about 3.5%. So that looks like this. Normally you want the short-term rates to be lower than the long-term rates. And the reason why that's important is because what it signals is that investors are less confident in the short term about the government reaction and the health of the economy than they are over the long term. And so when that happens, they start selling those short-term Treasury notes, And they're not buying the long-term treasury bonds either. They're holding cash, or they're putting money into some other things, trying to find investments that work. And the problem is that when we see those treasury yields go up, that means that people are selling and the prices of those bonds come down. So yes, you're getting more money on a yield basis to hold that treasury, but it's worth less. And so your real value of that note is a loss. And so it's a really confusing time. We've got housing prices that went way up and they're starting to come down. Our interest rates, because the Fed is raising the Fed funds rate, then our borrowing rates and other things like cars and credit cards and houses are now going up. We've had civil unrest over the past 2 years. This is an election year. We've had a crazy 2 years that came out of the 2020 election and how hotly disputed that's been, and a lot of weird political things. And now we have student loan forgiveness. We have oddities in the unemployment market. We supposedly have low employment, but no one can find workers, and people are still earning money in other places, so it's very strange. And then the stock market went absolutely bonkers, and we had meme stocks, and we had NFTs, or non-fungible tokens, and Bored Apes, and the metaverse, and SPACs, which are shell companies that could go public and then later bring in other companies that then get launched public that probably should never be, right? So crazy, a lot of crazy times. So then I stopped and I asked the client, hey, so all of that we just talked about, how much of that, if any, can we control? None of it, right? That's the answer. We cannot control any of that. So let's shift our focus to what we can control. And this is what I am saying to my other clients and to all of my clients. So the first thing is, when you work with me and Life Moves Wealth Management, one of the first things that we do is establish your financial purpose. You might think of this as like a list of goals, but it's not. Your financial purpose is the top 2, 3, maybe 4 things that are most important for you in your financial life and in your personal life over the next 2 to maybe 3 years. It's very difficult to make things important over 30 years because it's too far away. We've got FOMO that comes into play. We've got instant gratification that erodes long-term vision. So let's start by making really good short-term decisions, because those are going to set us up for better long-term outcomes. So what are those 2 or 3 things that are most important? Those things become your financial purpose. So all of the financial advice that I give over the next, say, 12 months goes to feeding those 2 or 3 most important things. All of the investment decisions go to feed those 2 or 3 most important things. Everything comes back to what is your financial purpose. So we can control that because it tells us what we're trying to accomplish. The next thing we can control is our investment allocation. We can control what's in our portfolios, how it's allocated, how much of the pie goes into all the various places. And we can do that by making sure that we are managing our investments to our risk number. Now, the risk number is Nobel Prize winning research that I use here at Life Moves Wealth Management. And it gives you a risk score based on how you answer very specific questions, right? The old way of you're a conservative investor, a moderate investor, or an aggressive investor, that no longer works. It puts people into boxes that they really don't fit into, rather than actually knowing exactly what amount of risk they're comfortable taking. So if you want to know what your risk number is, go to lifemoveswealth.com/therightfit. Very bottom of that page, click the what's your risk number button. It'll take you through a couple of questions, and it'll give you a risk number, and then it'll give us an opportunity to talk about what that means for you. So that's how we control investments. We can control how we react to headline news and market volatility. We can revisit our timelines. We can revisit our expectations based on our financial purpose. And the most important thing that we can control is the most time-tested and proven investment strategy that is the hardest to implement. And it's very simple. 2 steps. First, stay invested, right, based on our risk tolerance. And second, if you can, buy more. Because as the market moves up and down through volatility, when you're buying at different intervals, you're improving your long-term total return, because as the market recovers, and it will eventually recover, historically, go all the way back to 1926, think of everything that's happened, the market has always recovered over time. So if you're buying when the market's going up and down, when it gets up here, you have investments that are all over those and they're getting a higher compounded rate of return than if you pull all your money out and you sit and you wait for the market to get up here, because then you feel better that the market's recovered, and so now you're investing and you've missed all of that gain. So that's the most important thing we can do, is to manage our expectations, manage it to our risk, revisit our financial purpose, and make sure all of that's aligned. And turn off the TV. Don't watch the CNNs and the Foxes and the CNBCs and the MSNBCs and all those things, because their job is to keep your eyeballs glued and sell commercials. When your eyeballs are glued and they're selling commercials, you're thriving on the fear that they're producing, and it's going to cause you to be at risk to make bad short-term decisions for yourself that will financially handicap you down the road. So that's what I'm saying to my clients. So let me ask you, leave a comment, send me an email, give me a phone call. What are you seeing? How are you staying focused on the things that you can control? And if you're having trouble with that, what do you think would be helpful to you during this period of extended volatility? We've been at this for the entire year, and it's harder and harder the longer it goes on to stay patient. So, what are you doing to kind of help yourself stay in the right frame of mind financially? Leave a comment, hit the subscribe button while you're there, because I want you to be able to see these videos as they come out. And definitely go over to lifemoveswealth.com/therightfit. I'll put a link in the notes down at the bottom, and go find out what your risk score is. And while you're there, hit the button to schedule time to talk about it with me. I'd love to hear what's happening in your world and where your head is with all that's happening around us. So that's it. That's what I'm saying to clients. I hope this has been helpful. Take care.